Citi economists explained why gold is surging above $2,000, and what it could tell us. Key points. Citi economists say gold could reach $2,100 an ounce this quarter, and $2,300 in the next 6 to 12 months. But there are doubts it would hit $3,000. With gold topping the $2,000 mark this week, Citi economists have clarified exactly what they think is driving the surge in the precious metal and what it could tell us. The spot gold price, which currently stands around $2,058 an ounce, has risen over 4% this week and is set for its 9th week of gains in a row, its longest consecutive weekly increase since 2006. While there are doubts gold will hit the $3,000 mark, economists at investment bank Citi said in a note Thursday that they believe the metal could reach $2,100 an ounce this quarter, and $2,300 in the next 6 to 12 months, with risks skewed to the upside. However, they clarified that the gold rally was not forewarning of a burst of inflation, as some might suspect, despite central bank stimulus and rising private sector credit growth. The monetary theory of inflation has been replaced by labor and product market micro-theories, and market pricing of inflation risk is low, the economists led by Catherine Mann said. So gold is not presaging inflation. The gold rally was also not an indicator that the dollar would lose its crown as the premier international reserve asset. The economists said that while some have suggested gold's rise traces the depreciation of the dollar, no other currency or country is ready or willing to take on the dollar's role. In fact, the U.S. Federal Reserve's massive provision of dollars and currency exchanges with other countries, also known as swap lines, reinforces its position as the world's reserve currency. Even if the dollar is now worth less in gold terms, so too are all the other currencies, they said, meaning its exorbitant privilege remains. At its core, the economists said the rally in gold was being driven by central banks' monetary easing, which had resulted in negative real yields. This is when the return investors get on bonds is equal to or below the rate of inflation. This has reduced the opportunity cost of holding a zero-coupon asset such as gold. Nevertheless, they added that all of the above factors, and more, had a role to play in sustaining the gold rally. Guy Foster, head of research at Brewin Dolphin, agreed that what was driving the gold rally was negative real yields. These indicate the market's expectation of where inflation's going to be relative to where interest rates are going to be, he told CNBC's Squawk Box Europe on Friday. And the trade here is to say that the Federal Reserve and other central banks will not be able to raise interest rates because of high unemployment, even as inflation starts to pick up. Foster added. He said it was reasonable to expect inflation to rise to around 3%, which is the best part of a -3% real yield for investors. In that situation, you would expect gold to perform extremely well, Foster added.
I think the Fed, for instance, and the dollar, of course, super important for global liquidity conditions. The Fed has untapped potential in most of its programs. In fact, I think all of its programs. They're still talking about more fiscal stimulus in the US, and even though the case count, of course, in the US has been very concerning in the last month or two, the rate of hospitalisation and obviously fatalities also has been much lower than in the first wave. So even on the virus itself, it seems like we're learning how to manage it. Look, a bit better. Maybe it's less worse.
Right. Richard, good morning. Tanveer joining in this conversation. You have a big call coming in for gold. You're saying that your 6 to 12-month target on the yellow metal is $2,300 an ounce.
Look, the only thing you can say that's negative gold at the moment is that physical demand's not very strong, but that's not particularly unusual when you get these periods where the gold price is driven by broader factors. And I think, one of the very good features of this crisis, if you can kind of excuse those, they seem a bit in conflict, but it has been, is the size of the policy response. It's been absolutely extraordinary, but the cost of that, I think, is their increased speculative demand for gold. It's hard to see what changes that given the outlook for the virus over the next 3 to 6 months.
Right, but do you think this is a separate trade within the precious metals basket, or would you think that there's a bit of a rub-off because we're seeing actually all precious metals rally, silver included?
Look, and it's not just precious metals, of course, and as we get further down the precious metal spectrum, we start to get into industrial metals as well, because there's some dual-use metals in that mix. And I think that basket, so lower grade precious, I suppose, is also being influenced by what are some reasonable gains in the broader commodity complex.
And Richard, when it comes to the industrial metals, I mean, I suppose this story continues to improve as a result of what we're seeing on the data front out of China. Although when it comes to that services PMI yesterday, still some concerns about this gap between what's happening in the services recovery and the stronger performance we're seeing on the industrial side, and also what this means for unemployment. Is this something that worries you?
Look, it does actually. That's probably, I think, the biggest single economic issue globally is the fact that when you look at each individual economy, policymakers have tried very hard to get the production side of the economies back up and running because they involve less kind of human people-to-people contact. But of course, demand is still weak because of unemployment and even some restrictions on service sector activity. So that tension, I think, it's got to resolve itself over the next 6 months.